This is the Wealth Standard Radio, your gold standard in everything financial.
Hey everyone, welcome to the Wealth Standard Radio. This is Patrick Donohoe.
And I don't get overly excited for podcasts. Actually, I kind of do. But today I am definitely more excited than normal because of the guest that we have. His name is Matt Kerkhoff. He's the Chief Investment Strategist at Model Investing. And we are going to be talking about NERP 2. We already did NERP 1 a couple weeks ago. We're going to do NERP 2. And so it sounds like a video game. Not a video game. NERP is negative interest rate policy. But Matt is the guy to talk about this. And so we'll get to his background in just a second. So you'll learn why he's the guy to talk about, to talk really reality as opposed to speculation and conjecture about NERP. But before I introduce him again, I'm going to introduce you some Paradigm Life resources that we mention every time. Our new e-learning program is up on our website, paradigmlife.net. We'll put some links in the show notes. And we also have a new real estate investing section in there, and also a special section for clients. And so if you have some time and you want to educate yourself, great place to do so. And also we started a private Facebook page just for clients. So those of you who have done business with Paradigm Life, email us at clients@paradigmlife.net, and we'll get you access to that private community. A lot of cool exchange and collaboration going on. And it's a great way to ask questions and to also, you too, collaborate with like-minded people. Okay, so Matt, what's going on, man? How you doing?
Pretty good, Patrick. How about you? It's good to be with you.
I know, same here. I love talking with you. You're a smart guy. But let me give our audience kind of your background. So first, you really started in. You have a degree in the business side of things, and have a background in data analytics and model and statistical modeling. But you had an awesome opportunity to learn from one of the best financial writers in the business, Richard Russell, who passed away last year. But he, currently the Dow Theory Letter, which he started, is correct me if I'm wrong, the longest running financial publication in that's there today. Correct?
Yeah, you're correct, and still going strong even without Mr. Russell. It's been a kind of a tumultuous last year or so, but you're right. I was very blessed. I sort of have the classical business school training, but a lot of that doesn't necessarily apply to the financial markets. And so Richard was a blessing in that his focus was actually just watching and studying the markets for the last 60 years, and over that time he'd seen a lot of changes, and he was able to distill a lot of that information very succinctly, and I was able to learn a lot from his rich history. So yeah, that was sort of one of the key kind of turning points in my career.
Yeah, and looking at the idea of mentorship and learning from those who have walked the walk, there's nobody better, especially in that business. And you kind of took the reins and have a lot that you've written about over the last several years, and that caught the attention of Robert Kiyosaki. You've been on his radio program a number of times, most often with Andy Tanner, really talking about what's going on in markets and strategies, theories, and so forth. What's your experience? What's your experience been like on Rich Dad Radio?
Those guys are a lot of fun. We tend to see things quite differently, and it's entertaining because I think I get brought on the show because of my somewhat unique perspective, which really isn't that unique at all. I feel like their perspectives are often the ones that are kind of further away from the norm, but it always makes some really interesting conversation. And Andy and Robert are both brilliant guys, and they always have a ton to add to the conversation.
I bet, yeah, and it's entertaining to listen to you guys. I mean, there's a lot of information that's exchanged, but to your credit, being able to understand certain things and then formulate an opinion and defend that opinion, you've done a great job at that. And I know that the blogging that you've done, the articles that you've written, you've had to do that a lot, especially with those that may disagree with your perspective on things. But really, it's a testament to kind of what you've done But yeah, I mean, and today that's kind of what I'm hoping for, because, really, my philosophy is, I don't care who's right. All I care about is knowing what's right, knowing what the truth is. And oftentimes, truth gets, we're polarized with rhetoric, which clouds truth, right? And really getting to the heart of the matter, understanding something is really what allows us to, pierce through that cloud. And so negative interest rate policy has really been used and, in a sense to, sell newsletters or sell gold or get people kind of riled up. And, it's a marketing tactic, and a lot of that's used in other, with other topics. But certainly with NERP, because it is something that's relatively new because of Janet Yellen mentioning it, it's gotten, people in a tiff. So I can't wait to talk to you about that. But let's talk about our backgrounds, how I met you. So we met on the summit at sea, right? And that was I think two years ago, 2014. What are your memories of the summit at sea? We had a good time.
Well, that was the first cruise I had actually ever been on, and so my biggest concern was that I was going to spend the entire week trying to give presentations while trying not to throw up. But it turned out to be an awesome experience. Love the real estate guys, and the caliber of professional that was on that cruise was pretty amazing. I enjoyed meeting everyone, and actually I learned quite a bit during that 1 week time, and got to see a couple sweet places around the world.
No, cruising it's one of those like I don't know if I would go on a cruise like for like a leisure break, but still it's like one of those it's almost right, a perfect environment for that type of event, right? Because you're forced to collaborate, you're forced to meet new people, you're forced to have conversations, right? And you don't have really much escape. Plus you have tons of food and you have cool places, and people that have to actually flip a pretty high bill to actually go. So it creates kind of a good caliber of people so that you're not having, superficial conversations.
Yeah, and the fact that you're cut off from the rest of the world, more or less, really gives you time to actually reflect on sort of what's going on. It's like pushing the pause button. You actually get a chance to kind of sit back and think. So yeah, I get a kick out of that.
Cool. Yeah, I think we met like the first or second day, and it was like right off the bat, like we started talking about the Fed and monetary policy, and then Peter Schiff was on this cruise, and so we went into what we disagreed a bit about with him, which was very similar, and then we got to be on a panel kind of debating him, which it's kind of hard to debate in that type of environment with limited time, but still it was a cool experience on that front to kind of sync up with you, learn about you, learn about what you do, learn about your perspective on things. Mm-hmm. So that's what's going to be cool about our conversation today. So, so a couple of weeks ago, we talked about, what NERP was, what negative interest rate policy was, why it was mentioned by Janet Yellen, what countries are currently using it, what countries have used it in the past, what their results were, and then we kind of started to speculate on what the results in the U.S. would be. So when you kind of heard about NERP and negative interest rates, I mean, what type of analysis did you do? What type of things did you learn to kind of see what it was, and why the Fed was using this tool, which is probably one of their last tools, right, to essentially help aggregate demand and stimulate things?
That's a hell of a question. So it's interesting because as someone who is sort of classically trained in modern finance, you learn that everything hinges on what's called the risk-free rate. And ultimately, this is the prevailing interest rates that governments, which are theoretically the safest lenders in the world, lend money at. And that sort of sets a base rate for all other borrowing with an economy. And so it was interesting. During all my years in college and during my MBA program, the subject of negative interest rates actually never came up.
Wow.
It's something that wasn't really discussed with any legitimacy or seriousness until just a couple of years ago. It had been tried a few times in the past for different sort of event-driven crises, but nothing long-term, and definitely not on the scale that we're seeing now.
Mm-hmm. So you look at now, why would, because you look at the philosophy of the Fed. I mean, let's maybe start with that. Like, what are they with all the different, QE programs, with, the different tools that they have, whether it's, open market operations, or bond buying, the QE side of things, setting benchmark interest rates. What are they trying to accomplish? Like with everything that they've done, what are just generally speaking, what are they trying to accomplish?
Well, ultimately, modern economies these days are almost entirely based on credit. And so what we really see is sort of this link between the credit cycle and the business cycle. And so what the Fed is constantly trying to do is really stimulate the economy by encouraging people to essentially borrow and then spend and invest. Mm-hmm. That creates more economic activity, and it has a lot of positive sort of secondary effects. And so what we've seen over the last 3 decades or so is that the Federal Reserve, their primary mechanism for sort of juicing the economy, if you will, is to lower interest rates. Mm-hmm. And they've done this more or less sequentially over the last 30 years. If you look at a chart that shows the yield on the 10-year Treasury, over the past 3 decades, it's been slowly declining. And this has continually acted as sort of a tailwind for the economy, because essentially money has continued to get cheaper and cheaper and cheaper for the last 30 years or so. And now we find ourselves in this interesting environment where interest rates, at least at the short end of the yield curve, hit zero in countries pretty much all around the world. And now we're seeing some countries actually take that rate into negative territory. So, but what's interesting is there's sort of 2 sides to this whole discussion. One is what the central banks around the world are doing, and the other is what global investors are doing. Because if interest rates were only negative at very short durations, short maturities, we could blame that completely on the central banks, because they're responsible and they exert a lot of influence over those short rates. But the fact that we're seeing, for example, Japan's 10-year go negative, even their 20-year is dipping negative. Same thing with Germany, their 10-year is negative. These longer-term bonds are really controlled not by the central banks, but by the global investor community. And so we're seeing sort of the global investor community and central banks on the same side, just really pushing rates to rock bottom levels and below.
So what you mean by, mean by it's the global idea is that you have, governments purchasing, because they don't really have another safe place to put their financial resources. They basically buy, they put it into, whether it's treasuries, or the bond, the 10-year and the 30-year note, they put them into these, longer term, because it's a safe haven where they're going to lose a little bit. Okay, but it's worth losing some to have a safe place to have the money where you're not going to lose more. Is that what you mean by that?
Yeah, you're correct. What's happening is that global investors around the world are recognizing that the prospects for growth, some asset class that they can put their money and experience a relatively safe risk to reward trade-off, those areas have evaporated. Yeah. And so when you see a global financial environment that looks, risky at best, you're right. A lot of these bigger institutional investors are saying, hey, look, I'm just going to lock in a small loss, because at least it's a small loss. Mm-hmm. They're essentially telling you that they're happier taking that small loss than risking their money for a possible big loss somewhere else.
Yep. And that's kind of, again, it's counterintuitive to what these central banks really want, because they want people to invest. They want people to start businesses, invest in infrastructure, improve warehouses, improve factories, but they're not doing it, right? So now you have, people that are just like, I'm willing to take a loss, but I'm not going to invest because of what? Why aren't they investing?
At the end of the day, it just comes down to there are not that many lucrative places to put your money anymore. And one of the key things that underpins this is confidence. Lending takes 2 parties. You have to have an institution that's willing to lend, and you have to have a borrower, either an individual or a company, that wants money because they believe they can use that money productively to generate value. Yep. And so if either one of those parties loses, I'm just going to call it confidence, in their ability to either make a loan and have it repaid, or to take a loan and use it productively to earn additional money. Either of those scenarios don't exist. then you see this lackluster lending environment, which is what we're seeing. Even though money is essentially free, even though borrowers are in many places being actually paid to take money, they don't really care to in a lot of cases.
So it's this conundrum, right? Of it's the monetary policy around the world, which for all intents and purposes is very similar. Is trying to influence behavior to do something, but it's not working, right? So looking at the negative interest rate side of things, that's where people just want to keep liquidity, keep their money safe, even if it incurs a loss. So looking at Janet Yellen's comment, I mean they're again still trying to effectively create more demand, because more demand is basically you invest and you create products and people spend, and then the velocity side of things takes money and it goes from one hand to the other to the other, but it's not happening. Volatility is really low. So she mentions if we have to go to negative interest rate policy, we will do that. So in a sense, what am I missing, right? Because I say, well, you've tried it with low interest rates. Going negative, is it really going to suddenly flip the light switch on and say, all right, man, it's negative. I am going to go out and invest money. Or am I missing something? Because logically, that's kind of what I come to the conclusion of.
No, you're dead on, and that's the conclusion that a lot of people are coming to. When you consider that, let's take, for example, the last two recessions that we had. During those two periods, in order to sort of stave off the longer lasting effects of those recessions, the central bank in the U.S. dropped interest rates by over 5 percentage points both times. I believe it was 5.1% back in the dot-com collapse and 5.2% just recently. Mm-hmm. Those are big moves. And admittedly, we dealt with the financial crisis was perhaps the biggest catastrophe we've seen in many decades. So it was absolutely warranted. But it makes you wonder now. We're sitting with interest rates roughly a quarter of a point. Even if they were to go into negative territory, we don't have that much room to go because at some point interest rates. So far, we've seen them go moderately negative. No one has sort of had the guts to push them deeply negative. And part of the reason is because there are concerns that people will start to do things such as hoarding cash. Yep. You might actually get the reverse effect because people are going to start pulling their money out of banking institutions, at least the smaller individuals, and stuff it under a mattress, as opposed to paying the bank to continue to hold it for them.
Yep. And that's the confidence issue, right?
That is the confidence issue, exactly. And so you're right. Even if we are willing to go to negative interest rates, it's not like that adds a huge buffer. But the reason I think the Fed is starting to prepare or at least discuss the possibility is because it's all about perception. If the central bank does need to go into negative rate territory, they don't want that by itself to indicate to the markets that everything is lost and that this is, absolutely we're blazing a trail that we've never considered before. So in a sense, they're sort of preparing the markets, I believe.
So do you think markets are priced right now for negative interest rates?
That's a good question.
Because typically markets are priced in advance, right? So if there's, this announcement that, the Fed's going to do this or this is going to happen here or whatever, I mean, if there is a drop or a big gain, it means that the market hadn't priced it, right? So do you? I mean, what are your thoughts on the market being priced for negative interest rates?
I wouldn't say the market as a whole is priced for a certainty of negative interest rates. I would say some people probably are positioned that way, and some people are probably hedging for that type of scenario. But at least in the U.S., I don't think we are on the precipice of negative rates quite yet. Okay. And the primary reason I'll point to is what we're seeing with inflation figures. Inflation is by no means robust. Your headline inflation figures are running right around 1%. But core inflation levels, which exclude food and energy, are designed to be less volatile measures of inflation, are actually rising. The core CPI has been over 2% for, I believe, the last 6 or 7 months. And we're seeing a distinct upward trend in actually all the measures of inflation. So they're still low and muted. And we obviously have a lot of headwinds and a lot of global uncertainty there that could keep, inflation suppressed. And if that's the case, then we'll probably see more people prepare for a negative interest rate environment here in the U.S. But for every person that's preparing for negative interest rates, I think there are still people out there who believe that inflation is actually going to show itself. And if inflation does show itself, then we're actually going to see the long end of the yield curve actually move up slightly.
Okay.
It's going to be it's actually going to be a little bit of a favorable development. But the bad side is that it's probably going to end up with lower bond prices and then consequently lower stock prices if we do see that scenario.
So, all right. So looking at those scenarios. So, if you look at the Fed, they want inflation, right? They're trying to create growth, right? They're like, kryptonite is deflation, right? They don't want prices going down, right?
You're right. We are a debt-ridden society, and every time we borrow, we're basically pulling forward future consumption. And so the way that we sort of alleviate this is we inflate away our debts. That way we can have our cake and eat it too. We can keep the cycle going. Mm-hmm. So yes, the Fed and all these central banks around the world, everything that they're doing is really geared primarily towards stoking inflation. We need to inflate away some of the debt that we find ourselves with, and that will allow us to continue this credit expansion process and keep the economy.
Yeah, but at the same time, isn't it somewhat contradicting? Well, it is a contradiction because if you look at like right now, with the debt that we carry, we're still we're deficit spending, $1 trillion a year. So it's like, it makes sense if we were, net zero as far as spending is concerned, but, and because they would, inflation would cause the current debt to be cheaper, but yet we still keep going into debt, right? So isn't that kind of a contradiction to, the notion of them wanting to continue to have prices rise?
It's a complete contradiction. Economies grow through basically an expansion of credit, but that credit actually acts in sort of a deflationary way. It puts a crimp on future productivity because we have to pay back, we have to service all that debt. So inflation sort of becomes the other component to that process where we're going, okay, we're constantly expanding our debt, but once we've accumulated and acquired that debt, we sort of inflate its real value away. Okay. And that allows us to basically be at a point where, okay, the debt load is not so bad, even though our figures are higher, our actual debt figures are higher, it's not as overwhelming. Mm-hmm. And so then we can keep down that process of credit expansion, which is helping to keep the business cycle expanding.
So maybe another curveball, dude. I'm just throwing. So if you look at the total money supply, right? Because I know you have like trillions in excess reserves, but you look at like the total money supply and this idea of creating more and more demand. Does there come a point where there's just not enough stuff because stuff is what creates inflation, right? You have to buy things that can be their prices have to be measured. So does it come a point where you have not enough stuff to buy? Right? So that people are just not buying things, or you have kind of the technology that is continually trying to kind of it is suppressing prices.
It is.
Right? So you have all these different pressures out there. And I guess what I'm trying to lead at is, because I would assume that all these guys are smarter than me, right? And they see like that, that we're doing something that isn't going to work, but I just don't get it. I don't get like what's their logic behind doing what they're doing, because I just can't see a positive end game.
So first off, don't sell yourself short. A lot of these so-called professional money managers and professional investors, as distinguished and as brilliant as a lot of them are, they're still susceptible to groupthink and a whole host of other behavioral biases that cause us to sort of act in predictably irrational ways. And so we have this sense that other people know things that we don't. In some cases, it's true, but the fact of the matter is, markets and different things go off the rails constantly. There were, even just during the financial crisis. If more people had been aware of exactly what was going on in the excesses building in the system, perhaps that wouldn't have been quite as severe of a drop. But back to the inflation question, you're exactly right. The discussions about a money supply quickly get complicated, but if we try and keep it simple, in effect, what the central banks around the world are trying to do is increase the money supply. And if you can do that, everything else held equal, then you'll have more money representing essentially the same amount of goods and services or products, in which case the prices of those products and services will rise and we get our intended inflation.
Yep. So that's the thing is, I don't know if, I would say that there's not enough, because essentially if you were to look at a bell curve, like what part of the bell curve are they targeting to spend money? Like if you look at a bell curve and you kind of put in, whether it's, the middle class, whether it's, America, whether it's Asia, whether it's South America, I mean, what is the middle of that bell curve that the Fed and monetary policy right now is trying to stimulate? Because that's where I come to the conclusion of, okay, if they're trying to stimulate like middle class, are the ones that are, effectively, getting money to some degree, and they are, whether it's from, businesses investing and paying them more, which means they get more on their paycheck, and then they go out and buy stuff. Then there's not enough stuff to buy. So it's, there's always going to be kind of a cap to inflation or to prices. So is that who they're targeting? Are they trying to target somebody else? Like what would you say is like their primary, if we could get this demographic to spend money tomorrow by pressing this button, who would that be? Does that make sense?
Yeah, it's a great question. Whole sort of other can of worms talking about kind of the wealth effect. But so ultimately, if we do want to see inflation, right, we got to have more people, more individuals, more businesses buying products and goods and services. So there's a number of factors. There's quite honestly hundreds of factors that will influence that. But what's interesting is a lot of what the central banks have been doing has been reducing borrowing costs. Or cheaper for businesses to do this, but at the same time, this has had the effect of inflating asset prices. And when you inflate asset prices, you tend to just make the rich a little bit richer. Most of the poor and middle class don't have a lot of assets, and but conversely, they're the ones that actually spend on goods and services. A person who is wealthy, if they have more money, they're not really going to go out and buy more food. A lot of times, they're not going to buy a higher volume products. Yeah. A lot of that money oftentimes just gets, kind of saved. Their net worths go up. Fantastic. What we've got to do is somehow find a way for the poor and middle class to get their own sort of form of stimulus, because those are the types of people where if they do get a little bit more money, that money is going to actually be able to flow back into the economy.
Got it. Okay. That makes total sense. Okay. Yeah, I mean, so I guess kind of the transition as we finalize our thoughts. I mean, it's a complicated issue. And, I look at, and I'm not, we haven't had this discussion in a few years, but, I've always looked at, the Austrian business cycle. I know you have, normal, standard business cycle theory, but the Austrian business cycle theory really shows that, when there is this expansion of the money supply, when the Fed kind of comes in and tries to initiate what they're doing right now, right, it causes malinvestment, right? It causes people to, have this euphoric idea of their, I have a bunch of equity. I'm making a good amount of money. It creates this kind of, false sense of euphoria, which causes them to make bad decisions. And when they make those bad decisions, right, whether it's buying too expensive of a car or buying too expensive of a home or, spending more than they make using credit, that really starts to, cause malinvestment, bad decisions, which ultimately comes home to roost, and there's a correction that ensues. So as you've kind of looked at, okay, what's going on right now? What are some of the proposed policy changes, initiatives, and then analyze what the end game is, what's going to be the result? What have you what are you using to make that conclusion? If that like setup and question makes sense.
It does. It's the reality is that's sort of the question on everybody's mind is where does all this end? When is the final day of reckoning? I couldn't disagree with anything that you said. It's a very logical viewpoint. When you have cheap money just floating around, what it does is it lowers the bar. So if you had interest rates at 5%, anyone borrowing money would have to find a way of producing value that essentially grew in excess of 5%. The cost of money sort of creates that floor. When you have money that's essentially free, it means anyone with a marginally decent idea can go out there and get funding and see if it works. So there's kind of a give and take here. The first is that yes, it's definitely going to create a lot of malinvestment. The other part that I'm less clear or definitely more uncertain about is, by setting that bar lower, does it really? What we've essentially done is said, okay, now a business that can generate 2% growth is actually not a terrible business because money is dirt cheap. It can cover its debt costs and it can actually provide some value. So how that fits into the entire equation, I'm a little bit less certain. But you're right. Down the road, it's almost inevitable that we're going to see a rise in non-performing loans, and we're going to see a lot of this credit that was extended during this environment come back to sort of bite us the same way that subprime loans did just 7 or 8 years ago.
What are you? Because right now, so and this kind of is a kind of an extension of the same question. But what are you? Because right now you have like home ownership at an all-time low, right? So it's not going to be the same thing that happens, in 2008 to 2009. Okay. So what are you seeing as certain signals that tell you, okay, it's starting? Because I'll give you a few examples. So last year on the Real Estate Guys cruise, I found it time and time again where you had a ton of investors that started to invest in like 2010, right? And they had never invested before, but they suddenly got into this like it's like a perfect storm, right? They got into this like, everybody was selling, everybody was going into foreclosure, everybody was, banks just wanted to get inventory off their books. So people got in and they made, they were making a killing. But then last year on the cruise specifically, and there's another instance too, but on the cruise specifically, there were people that were like, well, I just did this deal and this deal. And it was like, why did you do that? Like, that doesn't make any, like buying in California where, you had this tiny bit of equity and you had this type of rent and it was like, dude, why are you, that doesn't make it. No, I didn't say that, right? But that's what I was thinking. And then another thing too was this, this was more recently, a couple months ago, where an individual was, he was like, he had a pension, he was retired, but he had like $1 million in cash. And he was making more money than he was spending. So I'm like, well, and he was like 7 years old. I'm like, why are you doing that? Like, why are you investing in a property? Why do you want to? Well, it's a great time to buy, and I want to invest, and I'm like, you don't have to. Like, what's the purpose behind it, right? So you see kind of this, like, again, this euphoria or this, this lack of understanding of cyclical cycles. And I don't know, I see signs, but yet at the same time, I see like this going on for a few more years. So what are some of the signals you're seeing? And, what do you think maybe are some of the like, culprits that if this happens, bang, you should keep your glasses on?
Right now, I have, my gut feeling is that, the party's going to keep going until there's absolutely nothing left in the tank. And so I do think that we could actually see a few more years of this. And we know, there's tons of financial metrics out there that show that, certain countries are leveraged, certain institutions are leveraged. The banks are obviously watched a lot more carefully these days, at least here in the U.S. and some of the, other areas. But like, for example, in China, we have very little idea of what's going on behind the scenes there. And the size of their economy makes things, very dangerous in a sense.
And you make that comment because China does not divulge probably, 100% of actually what is going on, right?
Yeah, they don't exactly. They're not forthright with a lot of their information, and even the information that comes out of there is often suspect. So what you typically see in scenarios like this is that the good times will continue to last, but kind of in the words of Hyman Minsky, that it's going to breed instability, and it's starting to do that. And so, just like we talked about, people taking out, loans and mortgages at, rock bottom interest rates, it's inflating asset prices. People feel pretty good right now. I mean, with bond markets near all-time highs and the stock market at all-time highs, no matter what you own or have owned over the last few years, you've done exceptionally well. But
you didn't do anything to do well. It's kind of
exactly.
It did it for you. It's like, oh, I have all this equity. It's like, well,
Yep. And every once in a while, some people will take some of that equity and spend it, put it back into the economy. But like we talked about earlier, a lot of these folks are so wealthy that, the numbers in their bank account just go higher. And that's ultimately the end of it. So no, what I've been watching a lot is these inflation numbers, because the world has been preparing for deflation, and that's sort of the biggest concern right now, and rightly so, because central banks have a lot of tools to combat excessive inflation. As you can tell, they're at their wits' end trying to prevent deflation. Yep. So if we continue further down the deflationary path, who knows, we end up in something similar to another financial crisis. Or on the other hand, if we do start to see inflation actually pick up, it's going to kind of reprice financial assets across the board. Bond owners are going to recognize that inflation is creeping up, and so they're going to want to charge a higher yield. So we're going to see interest rates rise. If interest rates rise, bonds are going to become much more competitive versus equities, and so we're likely to see equities pull back a little bit. But right now, there's kind of no indication one way or the other. The U.S. economy is stuck at this, apparently now it's a 1.2%, growth rate. And everywhere around the world, everyone's just kind of stuck. It's almost like I hate to use the term, but secular stagnation. It just seems like it's everywhere. We've grown as far as we can. Economies are so big right now that they can't continue to grow at a strong pace. So we could continue to juice things for a while. Money's probably going to stay cheap for a long time. And conversely, that's going to have a big effect. Like I said, the interest rates underpin all the value of all financial assets. And so when interest rates stay this low, it's going to continue to prop up the stock market, just like we're seeing.
And that's a big, and the stock market is one of those like benchmarks that has to do with confidence, consumer confidence. And, when their bank accounts are big, they feel great. When their bank accounts are small, that's when they freak out. So, I was hoping you'd argue with me more. Hopefully you'd say you have no idea what you're talking about. But I just think it's a topic. You said it, as we were preparing for this, you said it's just kind of one of those like topics where you don't know what's going to happen, right? You don't know what the Fed's going to do. You don't know like what's going to cause a trigger. But in the end, it's like the artificial stimulus and what they're trying to do is just not working, and they're running out of options. And who knows what's going to trigger it? It could be like some massive technological advance. It could be something happening with car loans and student loans. It could be something happening in China. It could be something. Who knows what the event is going to be? But I would conclude that we're in a fragile situation. Right. And when something does happen, people will react probably more irrationally because of the fragility of the situation.
Mm-hmm. No, you're right. And to say the same thing kind of a little bit differently, we always talk about risk premium when it comes to investing, which is, at the simplest level, the compensation you get for bearing risk. Well, in a lot of the financial markets, we've seen risk premiums almost evaporate. You were just not, to put it simply, you were not getting compensated well to carry risk in this type of environment. So it's, I think we're going to start to see more people recognize that. But these money managers who are controlling, literally billions and trillions of dollars of flows, they got to put their money somewhere. Those guys can't take it out and stick it under a mattress. They can't put it in a savings account at JP Morgan. They got to find something to do with it, and so it's interesting to watch what they're choosing to do with it, and the fact that they're choosing to actually invest it at negative interest rates is interesting. And this whole world is so confounding. If you think about it, this negative interest rates, what it's actually doing is Japan, for example, they're actually borrowing their way back into prosperity. They're actually making money by being a debtor. And so that, again, things are kind of turned upside down, and you sit there scratching your head and you're going, well, how does this work? So you're right. There are way more questions out there right now than answers. Maybe the only certainty we can kind of agree on is that, the situation, thanks to a number of factors, financial markets move so much faster these days. And when there are precarious scenarios, it just means you got to pay a lot closer attention and be a lot more agile. These folks that just have money kind of just, sit in some place safe and it's been sitting there for a long time, whether it's invested in stocks. I'd suggest you find out where your money is and what it would take to move it around. If and when we do see things start to deteriorate.
Yeah, because when that time comes, there's going to be opportunities, but it could be in a location where it's not as liquid as you think. And also from a psychological standpoint, if you had money in a certain place for long enough, your sudden, wow, I should do something. It's going to be like, oh, you kind of you waver. And so it's really it's the education side of things that says, okay, this is when you should move. This is how you're going to move. And this is, again, what the mechanics are between, money is here, money is going to go here, and then money will go here, for the different scenarios. But all right, dude. Well, NERP, maybe we'll do a NERP version 3 once Donald Trump is, or not Donald, whoever's elected. I'm just kidding.
Do another one in 6 months, and I'm sure everything will be completely different.
Probably, most likely. All right, dude. Well, why don't you give? Let's transition a second and then finish this thing off. But right now, you're working on a new project, right? You have a new site. You discovered this model that you're super stoked about, and you're trying to get off the ground. Why don't you take a moment and explain that, and tell our listeners how they can access more information about that?
Sure. So I've been studying and watching the markets for decades now. And it's very entertaining, but it's an emotional roller coaster, and frankly, it's difficult. A money manager who's right 6 out of 10 times is considered to be at the top of their game, top of the industry. And so you spend all this time and energy, always trying to figure out what's going on in the world and keep tabs on the latest data point out of every country and all this stuff, and it ends up overloading your brain after a while. And so what we found is, and this trend started, many years ago, but what we found is you end up sort of in these environments where your investment decisions can be assisted by a computer that is essentially running through a whole lot of that data for you. So what my team and I have done is we've gone out, we did a lot of research, and it turns out actually all we had to do was aggregate a lot of research, because over the last 40, 50 years, tons of academics and other folks out there have literally studied the stock market from almost every angle you could imagine. And they've discovered these so-called market anomalies, which are these predictable patterns in prices and asset prices that really shouldn't otherwise exist. And for a long time, the entire academic community didn't know what to make of it. They didn't know why it existed. A lot of proponents of efficient markets said, well, that really can't exist. But it does. And as we've learned more about behavioral finance and behavioral psychology in the last 5 to 10 years, we're starting to realize that these patterns exist and actually are exploitable because of the irrationalness of investors. And there's in a sense of predictability to that irrational behavior. And so the company that we just started is called Model Investing. And the idea is that we've built a series of investment models that actually go and track what's going on in the financial markets and essentially act as a decision support tool. They'll tell you where your investment should be allocated or what your investment should be in for the following month. Now notice that we're not forecasting out years, we're not forecasting out decades. This is exactly just 1 month. So we call this performance-based investing. Essentially what we're doing is we're looking out and we're saying, okay, based on the current economic landscape, what's likely to outperform during the next month? And then as we go through that month, we're going to reevaluate the scenario. And so what we've done is we've basically made these available to the public, and investors can actually follow our models exactly, or they can use the analysis that we provide to kind of create their own investment strategy. But it's a very unique way of investing that sort of capitalizes on what's considered the only lasting market anomaly, which is momentum. And it does it in a way where it's very low cost, sort of self-service. You can manage your own 401k, or you can manage your own TSP account using some of the recommendations that our models create. And we did all kinds of testing when we put these together, and I'm a confident person, but the humble side of me has to admit that these investment models have actually performed better than I have over the last 15 years or so. They foresaw things that I did not, and the beauty is those models make all their decisions objectively. They're not subject to the behavioral biases and the emotions that go hand in hand with investing. So a lot of times when I was tempted to get everything out of the market, these investment models were saying, no, now's the time to really be in the market. And the vast majority of the time, the models ended up being right. So
and that's so. It was interesting. I was on vacation this past week, and I was reading a book, and one of the ideas in there, it said that if a human being knew everything about mathematics, they could look at anything and understand exactly what's going on, why it occurred, and what's going to happen in the future. And so I think you look at, and again, this is probably a topic for another day, but you look at just all the data that's out there and all of it that's being, all of it really that's digitized, and really looking at trends and using, whether it's quantum computing or using, other methods to really crunch and formulate patterns, using artificial intelligence and so forth, really does create more accuracy. And it's not just, on the investing front, but, on the insurance front, right? Looking at car insurance or health insurance or life insurance, right? It really creates better probability models. So it's fascinating that you kind of are on that trend line as we're kind of going into this, this space of maybe perfect math, perfect numbers, which I don't know if it's a possibility, because you always have the irrational side. But if you can start to predict exactly what a human being is going to do in this circumstance, and given this, what they've done in the past and what they're getting, it's fascinating to think about. But if you look at a lot, companies today like Amazon, Overstock, they use, this predictive analysis to determine like what you're going to buy, what ads you should see, what are your favorites, what are the recommendations, and then they'll pre-ship stuff to a local warehouse, because there's a probability that you're going to click on that thing and buy it, right? So you look at it, in the retail and the e-commerce world, but the same thing applies to investing, I would assume.
No, you nailed it. This whole concept, really, it just boils down to pattern recognition, yep. Right? And the more, the better that companies can essentially recognize different patterns to their, inventory or sales or whatever it might be, the more that they can optimize. And so we're seeing this in every business around the world. It's been slowly working its way into the investment business for some time now. And so it's inevitable that really moving forward, computers and sort of these advanced algorithms are going to be doing a lot more of the data crunching and analysis side of things for us. And frankly, it's more than even a team of investment analysts can do. And typically, it at the very least provides a fantastic input into the decision-making process.
Well, whenever you add a human being, it adds subjectivity. I mean, it's just
right.
Opinions, biases. They carry things, and they're of course fallible.
Yeah, I'm one of those people who can admit that we're all crazy. In some way or another, we're all kind of nuts. We all act irrationally from time to time. And unfortunately, money and financial decisions tend to magnify that effect. There's a lot more on the line, and so we become more emotional. So this is just kind of a unique way for us to sort of remove the subjectivity, see what a completely objective approach to investing would actually recommend. And like I said, we're trying to help out some of these ordinary folks, the middle and lower class, who are just contributing money to a 401k, but just want to be able to have that 401k better positioned for what's ahead.
Well, so tell listeners how they can learn, because I know this is this project is kind of in its infancy, but it's live. You're blogging about it, you're talking about it. People are using the service. How can people learn more?
Yeah, the company itself is called Model Investing, and our website is probably the easiest and fastest way to kind of find out more about us. And the website is just modelinvesting.com.
Cool. And they're like, what can they expect on your website? Do you guys have articles? Do you have like a trial? Do you have what are some of the services?
Yeah, we offer a free 1 month trial for everyone, and we're of the position that if we're not benefiting you, we actually don't want your money. And so we offer that 3 month trial to see if we're a good fit and you like our approach and style to investing. And if you do at any point, we offer a prorated refund. So what we're really trying to do is make the service available to as many people as possible. And our price point is very low. We actually offer access to all of our investment models for less than the price of a monthly gym membership.
Wow.
So, most people have that membership kind of sitting off to the side. They don't really use it that often. Now for the same price, you can basically have access to cutting edge investment models that have a very, very strong track record of investing through all types of economic conditions. Some of our models actually even profited during the financial crisis because they were actually able to recognize the vastly deteriorating conditions in the early stages of that collapse, and literally moved either to cash or to bonds to ride out the storm. So we don't expect anyone to immediately embrace our investment models as as taking complete control over their retirement accounts, but it's something we want people to get a little bit more accustomed to. We want people to start watching and following, recognize that there are other solutions out there, and they can get more sort of fine-tuned guidance in terms of where their portfolio should be allocated at any given point in time.
Cool. All right, dude. Well, it is. I've known about this for some time now, and I'm excited that it's finally launched. And it's fascinating. So for those of you listening, it's Matt's as smart as they come. Follow him. He blogs quite a bit. He's always posting his wisdom online. So go check him out. We'll put all the links to contact him in the show notes. But thank you for listening today. I know it's been kind of one of those topics where it's like, you could hopefully you're to this point in the podcast and haven't turned it off already, but. It's one of those topics where, it might seem cumbersome, but at the same time, it's something to pay attention to look at, what could potentially happen in the future, and when it does, how to profit from it. So, that being said, Matt, it's awesome to have you on. Thanks again for your time, and for you folks listening, we'll be on next week, and we look forward to talking to you then.
Awesome. Thanks, Patrick.
You've been listening to the Wealth Standard Radio Show, your gold standard in everything financial.